Picture this Sunday night ahead of a Monday open is when signals carry the most weight. Mexico is in crisis. Not the slow-building kind that unfolds over quarters, the fast-moving kind. Military deployed, segments of airspace restricted, flights canceled, and at the center, a major operation reportedly eliminating one of the most powerful cartel figures in recent history. Details are still unfolding, and I'm not here to speculate on the political angles. My role is to connect the financial dots others won't connect for you. Mexico is the largest silver-producing nation on Earth. Approximately 1 out of every 4 ounces mined globally originates from Mexican ground. That is not trivia. That is structural reality. Any meaningful disruption there feeds directly into worldwide silver supply. Road closures, transport bottlenecks, restricted air corridors, none of that instantly halts production. Mining doesn't function that way. But here's the critical point. This market is already tight. In the previous video, we covered how speculative long exposure in silver sat near 20-year lows, even as price advanced aggressively. We discussed the Shanghai premium signaling physical demand outpacing paper supply. A market already constrained does not require a total shutdown to reprice. It requires uncertainty. And Mexico is injecting exactly that in real time. Silver is not currently priced for a supply interruption. The $84 paper price assumes output continues flowing normally from the world's largest producer. Physical moves first. Paper reacts later. That order matters. Those who understand how commodity markets respond to potential supply shocks know why this headline deserves far more attention than it's receiving. Now let's layer in the gold-backed crypto signal, because this answers the question many woke up asking today. PAXG, the token backed 1-to-1 with physical gold, is trading roughly $50 above Friday's Western close. Spot gold in Western markets finished the week near $5,098. The token is already above that level on Sunday before traditional markets reopen. What does that imply? Crypto trades 24 hours a day. Gold-backed tokens function as real-time sentiment indicators while futures and spot markets are closed. When you see a $50 premium forming on a Sunday evening, you're watching participants bid for gold exposure during hours when conventional access is unavailable. That is forward-looking information, not certainty. Gaps fill. Liquidity distorts. Weekend pricing does not dictate Monday's institutional open, but it is directional data the informed minority tracks, while others wait for post-move explanations. If gold follows through, the level that matters is last week's high, specifically the Wednesday, February 11th high, which also marked the prior weekly peak. That is the structural barrier price must clear to confirm continuation. Let me be precise here. This is tape reading education for short-term traders. I am not forecasting price. I am not issuing signals. I am explaining the structure as it stands. Understanding how professionals interpret price action is part of the financial warfare education this channel exists to deliver. One contextual factor that shifts how you interpret any Monday move. Shanghai remains closed Monday and reopens Tuesday. That means liquidity will be thinner than normal. Thin liquidity amplifies volatility both ways. A gap higher in gold with Shanghai offline could appear stronger than underlying demand supports. A reversal in that environment can be just as violent. Short-term traders need to remember, light liquidity is not confirmation. It demands greater caution, not less. On silver specifically, the lower time frame structure remains intact as of now. The next objective on the tape is 86.3, which aligns with a prior weekly high. That's confluence. When a technical target overlaps with a structural memory level, it carries more significance than either alone. Above that sits a resistance band between $87.2 and $89. This zone is not meant for slow grinding consolidation. If price enters that range and stalls, momentum weakens. What is required there is decisive expansion, movement with force and participation, not time spent hovering inside it. Again, this is structural reading for short-term participants. Not advice, not prediction. Just the current market framework as it stands. Now here's the mid-level reveal. The layer tying all of this to something far larger than a Sunday premium or temporary airspace restrictions. In the last video, we covered the dollar's share of global reserves falling to its lowest level in 32 years. Discussed central bank gold holdings surpassing Treasury holdings for the first time since the mid-1990s. And we touched on the quiet delivery dynamics building inside COMEX. Let's expand that. With 4 trading days remaining before last notice on the February gold contract, open interest still represents more than 436,000 ounces, approximately 13.5 metric tons. That figure stands at 24 times the typical open interest seen at this phase of the delivery cycle, and more than double the largest prior contract at the same point historically. Even more striking, February's open interest exceeds the upcoming March contract. That likely has never occurred in the documented history of this exchange. For those who have tracked COMEX delivery cycles over years, that pattern usually indicates a short position carried beyond first notice day with the expectation of exiting, only to discover liquidity evaporating. Friday's total volume was 134 contracts. That is not deep liquidity for unwinding a position of that magnitude, which raises the obvious question, does that short possess the physical metal required for delivery? If not, historical precedent suggests one of the major bullion banks may step in late cycle to issue delivery notices, creating ripple effects of its own. The physical market is already tight. The February contract structure is statistically abnormal. And we approach Monday's open with gold-backed crypto already signaling a $50 premium before Western desks power on. G. Edward Griffin detailed in Creature from Jekyll Island how concentrated short exposure in paper gold markets functions not merely as speculative positioning but as a mechanism of price influence. He was labeled conspiratorial when he published that thesis. Since then, we've witnessed the $9 to $20 million JP Morgan precious metals settlement in September 2020 and documented CFTC enforcement actions confirming manipulative practices in the very markets he described. These are not abstract theories. They carry case files, settlement figures, and formal admissions. The February open interest anomaly mirrors prior episodes where heavily exposed shorts faced tightening physical supply with limited exit liquidity. The rhyme is difficult to ignore. Layer in geopolitics. The situation involving Iran has not disappeared. It has shifted classification. The United States signaling acceptance of uranium enrichment rights may appear de-escalatory on the surface. It is not necessarily so. Significant military hardware has moved toward the Middle East at levels not observed since 2003. Hardware of that scale does not automatically withdraw following diplomatic gestures. Strike risk may not be eliminated, merely deferred. Markets pricing metals at current levels are incorporating geopolitical tail risks that have faded from headlines but not from strategic calculus. Meanwhile, a monetary regime transition accelerates quietly. Since the 1970s, global reserves have revolved around the US dollar and treasuries. That persistent demand enabled sustained deficits while exporting inflation abroad. Foreign buyers absorbed treasury issuance and financed domestic consumption. The freezing of Russian reserves fundamentally altered that framework. Nations that once viewed dollar reserves as neutral now recognize their vulnerability. Central bank gold accumulation surpassing treasury holdings for the first time since the 1990s is not random. It is a measurable reaction to that recalibration. As reserve managers pivot toward gold, fewer inflationary pressures are exported. More remain internal. That is not ideology. That is arithmetic. Jim Rickards articulated this dynamic in Currency Wars, how reserve currency status allowed the United States to externalize inflation via seigniorage, and how the erosion of that privilege forces inflation home. That process is unfolding in real time. Now, the honest counter-argument. Lighter liquidity on Monday with Shanghai offline creates a two-sided risk. A gap higher can reverse just as violently in thin conditions. Mexico's instability, while structurally relevant to silver supply, has not yet produced documented output reductions or shipment interruptions. It represents supply risk, not confirmed disruption. Markets may price that risk and fade it if stability returns. The February COMEX anomaly, though unprecedented statistically, has historically resulted in managed resolutions without full systemic breakdown. Bullion banks have navigated similar stress before. That does not guarantee repetition, but ignoring that possibility would be intellectually careless. And for every analyst projecting triple-digit silver, five-figure gold, or ratio-driven reset valuations, those projections rest on historically valid balance sheet mathematics, but on timelines that may extend far beyond most investors' patience or capital durability. Howard Marks wrote in Mastering the Market Cycle that being correct on direction and being correct on timing are entirely separate disciplines. Confusing them destroys portfolios even when thesis proves accurate. Taken together, here is the synthesis. Mexico has introduced authentic supply uncertainty into the largest silver-producing jurisdiction. at a moment when physical silver already operates within structural deficit, and COMEX registered inventories sit well below open interest demanding delivery. The gold-backed crypto premium ahead of Monday signals directional pressure, not certainty. Gold's structure points toward last week's high as the first confirmation threshold. Silver's chart maintains integrity, targeting 86.3 next, with a resistance band above requiring decisive expansion rather than passive absorption. Shanghai's reopening becomes pivotal, the first major physical price discovery following a week offline, re-entering a landscape shaped by Mexican instability, unresolved Iranian risk, and a historically irregular February delivery structure. The monetary transition is not hypothetical. Data confirms it now. Central bank accumulation, declining dollar reserve share, elevated Shanghai premiums, and delivery stress inside COMEX. This is not speculation. It is pattern recognition grounded in verifiable data. This channel provides financial warfare education, not recommendations. Confirm every data point independently. COMEX delivery statistics are public. COT positioning is public. Shanghai premiums are public. Those who examine primary sources will understand why this moment is not background noise. Operate with discipline. Reject hype. Think structurally.